Hello and welcome to another My Solo 401k Financial YouTube webinar. We're just testing the audio and we'll be getting started here momentarily. Thank you. All right, great. So please let me know if you cannot hear the audio. You can chat over questions in the chat box. All right, thank you so much for joining. If you're on our YouTube channel, please like and subscribe, as we will the goal is to be having these weekly sessions to go over deep dive topics. So that way you can get notifications, get access to the recordings, etc. So this is going to be the first in a series of deep dive topics, specifically of how much income do I need to maximize my solo 401k contributions. This is a very common question that we get when clients are trying to figure out, again, how much self-employment income do they need in order to maximize the solo 401k contributions. So today's session is focused on self-employed businesses that are taxed as an S-Corp, a C-corp, where they're reporting income as W-2 wages from the self-employed business. It could be an LLC taxed as an S-Corp or a C-corp, etc. So first off, some housekeeping. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. All right, let's take a look at the agenda. So again, the topic is how much self-employment income do I need to maximize those solo 401k contributions. We want to first highlight the resources. So we have a daily webinar on our community, mysolo401k.net/my-community. On that daily webinar, we also have, or I should say on the community, we also have a video library with hundreds of videos. So it's totally free to join. All are welcome. We go live on our community Zoom call every day at 1 p.m. Pacific, 4 p.m. Eastern. So it's a great way to learn and to see what other people are asking, to come and ask your own questions. So you can see the community here again, mysolo401k.net/my-community. You can scroll down here. You can click on, you can see the video library. We've got hundreds of videos here. It's all sorted by different categories, etc. So it's a great couple of resources. So please engage over there. We're also going to go over the solo 401k basics, right? So eligibility, top use cases, the solo 401k contribution factors, solo 401k contribution limits, how much income do I need to make, some scenarios, some examples. So hopefully that helps lay it out here. I think we might be having an issue with the audio. One second, let me just verify. Thank you so much for your patience. All right, it looks like it's still okay on my end, so we're going to keep going. So first off with eligibility. So who's eligible to set up a solo 401k? A solo 401k is for an owner-only business with no full-time W-2 employees. So think like an independent contractor, could be a solo practicing attorney or CPA, a realtor. So the key is that you're self-employed with no employees working for any business that's owned by you or a spouse, if any, no full-time W-2 employees. In terms of some of the top eligibility considerations, number one is, do I need a separate entity like an LLC or an S-Corp? The answer is no. We have many clients who operate as sole proprietors, so they don't have a formal legal entity, and that's fine. The key is that you are reporting earned self-employment income on your taxes. So for example, on Schedule C, if your self-employed business is taxed as a sole proprietorship, or it could be W-2 wages. If your self-employed business is taxed as an S-Corp, like the focus of this session. There's no minimum amount of earned self-employment income that you need in order to be eligible to set up a plan. But of course, as you'll see as we go through the slides, your ability to contribute to the plan is a function of your earned self-employment income, right? You can't save more than you earn. Your spouse or business partner may participate as long as your spouse or business partner is reporting their own earned self-employment income. For example, say each spouse is receiving a W-2 from the self-employed business taxed as an S-Corp. You can set up a solo 401k even if you have a W-2 job, even if you're participating in your W-2 employer sponsor plan. Now, as far as some of the top benefits or use cases, number one, of course, is going to be contributions. So with our plan, you can contribute up to $66,000 or even $73,500 if you're 50 or older for 2023. Those could be made as pre-tax contributions to reduce your taxable income, or they could be made as Roth contributions or even Mega Backdoor Roth contributions, where you have the potential for tax-free growth. Another popular reason that clients set up accounts with us is the ability to invest in alternative investments, like say real estate or notes, precious metals, private placements, etc. And as part of the onboarding process, we're helping our clients open up accounts at the bank or brokerage of choice where they have checkbook control over the money, which it makes it easier for them to act quickly on an investment opportunity. Lastly, is our plan allows for 401k participant loans. So this is where you could borrow up to 50% of the balance, not to exceed $50,000, and use the money for any purpose whatsoever. The loan just needs to be documented, which we handle that documentation as part of our service for no additional charge. So we prepare those required loan documents. The terms of the loan would be that it needs to be paid back in either monthly or quarterly payments back to your solo 401k, equal payments of principal and interest. The interest is either prime plus 1%, or it could be a CD rate plus 2%, with those payments spread out over a 5-year term. All right, so now let's turn to these contribution. Let's drill down into one of those top use cases, which is contributions. So when considering how much you can contribute to the solo 401k, one's ability to contribute to the plan is based on different factors. One is your self-employment income, right? The concept of not being able to save more than you earn. Another is your age, right? Once you're 50 or older, you can make catch-up contributions. A third would be whether you participate in another plan, like a day job plan, because your ability to make employee contributions, that employee contribution limit, which for example, for 2023 is $22,500 or $30,000 if you're 50 or older, that limit applies at the employee level. So across all the plans that the solo 401k owner is making contributions to. Lastly, an important contribution factor is the type of contribution, right? Is it an employee versus employer? Are you trying to make pre-tax, Roth, or after-tax? So that'll become clearer as we look at the different scenarios that we're going to review in a few slides. So the first factor is self-employment income. So how you determine self-employment income depends on how your business is taxed. So for a business taxed as an S-Corp or a C-corp, could be an LLC taxed as an S or a C-corp, your ability to make solo 401k contributions is based on the W-2 wages that you receive from your self-employed business. So you don't consider W-2 wages from other sources like a day job. You don't consider the profit distribution, so the K-1 that you receive from the S-Corp. It's really based on the W-2 wages from your self-employed business. So what does that mean exactly when we say W-2 wages? So you use box 1 of the W-2 plus any pre-tax selective deferrals in box 12. So that would be if you're making that pre-tax employee contribution of $22,500, right? That's going to reduce box 1 because it's made on a pre-tax basis, and it's going to instead be reported over in box 12. So when you're determining, okay, what is my W-2 wages, it's really box 1 plus box 12. So how much can I contribute? In other words, what are the limits? So for 2023, the limit for employee contributions, also known as salary deferrals, is 100% of your W-2 wages from your self-employed business, not to exceed $22,500 or $30,000 if you're 50 or older. And those contributions can be made as pre-tax or Roth. Now, like we talked about, you would need to reduce that by contributions made to another plan, right? That's one of the factors, whether you contribute to another plan like a day job plan, because that employee limit applies across all the plans that the employee makes contributions to. The one exception to that rule of having to aggregate would be if the other plan happens to be a 457 governmental plan. So like I mentioned, that those employee contributions could be made as pre-tax, they could be made as Roth. If they're going to be made as Roth contributions, those Roth contributions go into a separate sub-account. So as part of our onboarding process, we're helping clients open up the requisite number of accounts at the bank or brokerage of their choice. So they might have a pre-tax account, a Roth account, and then even a third voluntary after-tax account, which is how one makes Mega Backdoor Roth contributions. So the second type of contribution, right, back to the factors, right? What type of contribution are you looking to make? The second type of contribution would be an employer contribution, also known as a profit sharing contribution. So the limit for a self-employed business taxed as an S-Corp is 25% of the W-2 wages, right? That goes back to our discussion of okay, what exactly is W-2 wages? Well, it's box 1 plus any pre-tax elected deferrals not in box 1. So if your W-2 wages were $100,000, and let's say that you were 50 or older and you made a $30,000 employee pre-tax contribution, well, your box 1 is going to be $70,000, right? Because that was a pre-tax contribution that reduced your income. And the $30,000 pre-tax employee contribution instead would be over in box 12. So when you go to make the employer contribution, the profit sharing contribution, you know that the limit is 25% of your W-2 wages, but it's really 25% of what, right? Is it 25% of the 70,000 in box 1? No, it's 25% of 70,000 plus the 30,000. So 25% of 100,000. So $25,000 in that scenario. So it's important to keep in mind that it's important to keep the overall limit in mind. So that's our second sub bullet there. So the aggregate contributions, in other words, the employee, the employer, any voluntary after-tax contributions that are made to the solo 401k can't exceed the overall limit. For 2023, that overall limit is $66,000 or $73,500 if you're 50 or older. And then our last point here is that unlike the employee contribution limit, which considers plan contributions made to another plan, like a day job 401k plan, the employer contribution limit is at the employer level. So you don't have to reduce your ability to make employer contributions to the solo 401k by contributions that are made to a day job 401k plan. Now, the one exception to that rule would be a 403b plan. So with the 403b plan, you really consider all the contributions made to the 403b, whether it was made by you or whether it was made on your behalf as an employer. You aggregate all of those 403b contributions with the contributions that you would want to make to the solo 401k, and you have to make sure that all of those contributions in sum don't exceed the overall limit. So that's the 403b exception in a nutshell. Okay, so what about these? You may have heard that now there is the ability to make employer contributions as Roth contributions, which came into effect at the end of last year under the Secure Act 2.0. So The upshot is for a solo 401k plan like ours that allows for Mega Backdoor Roth contribution, this change really offers no substantive benefit, because with our type of plan, one is able to make voluntary after-tax contributions, which you're able to reach the limit much faster with those voluntary after-tax contributions, because you can make voluntary after-tax contributions on a dollar for dollar basis. In other words, 100% of self-employment compensation, and quickly reach the limit. Whereas if you're trying to make the Roth contributions as an employer contribution, remember, you're still going to be limited to that 25% rule. Also, the deadline to establish the plan is the same, so that's no substantive benefit. You have more flexibility in transferring the after-tax contributions out to a Roth IRA. So that would be another advantage for our pre-existing plan, which allowed for voluntary after-tax contributions. And then there's uncertainty, that last Q&A there, about how to even report those employer contributions made as Roth contributions. So that's, again, where the upshot is that there's no substantive benefit of making those employer contributions as Roth contributions. So our last type of contribution is voluntary after-tax contributions. So here, the limit for voluntary after-tax contributions is 100% of self-employment compensation, dollar for dollar, up to the overall limit. And you just have to reduce it by any other contributions that were made to the plan, right? So if you are under 50, you made $22,500 as an employee contribution, assuming you have at least $66,000 of self-employment compensation. So say W-2 wages, you could make the difference, assuming you don't make any employer contributions, you can make the difference all the way up to 66 as a after tax, and then move it over to the Roth. And we'll see that in one of the scenarios to help bring that to light. So now let's turn to these scenarios, right? Again, the question we're trying to answer is, how much income do I need to make to maximize those solo 401k contributions? So our assumption here, or I should say the goal is, first, I want to maximize solo 401k contributions while keeping my W-2 wages as low as possible, right? Based on feedback from clients and just our understanding is that some individuals, they want to have their self-employed business taxed as an S corporation, because that allows them to reduce their self-employment tax, because they only end up paying self-employment tax on the W-2 wages. And then they've characterized some of the income that they're making from the business as really owner income. So it's not subject to the self-employment tax. So there is a goal for some individuals to keep their W-2 wages as low as possible, of course, within those general S corporation rules. So, but we also know that their ability to contribute to the plan is a function of the W-2 wages. So there's a tension, like, okay, well, how much W-2 wages do I need to be able to maximize the solo 401k contributions? So let's assume that their self-employed business, again, is taxed as an S or a C, could be an LLC taxed as an S or a C. There's just one participant. This individual does not make contributions to another plan, like a day job plan. They want to contribute 100% of those W-2 wages to the solo 401k, and they're only looking to make employee contributions, so not employer. So in that situation, they would need $22,500 or $30,000 if they're 50 or older. In that case, they'd be able to contribute 100% of the W-2 wages, dollar for dollar, as an employee contribution. It could be made as a pre-tax contribution, could be made as a Roth contribution. They wouldn't make any employer, they don't make any after tax. So that's scenario number one. Scenario number two is, okay, we will still want to maximize the solo 401k contributions. We still want to keep those W-2 wages low. So really the same basic assumptions, right? As far as the self-employed businesses, an S-Corp or a C, from a tax perspective, one participant, they don't make contributions to their day job plan. They want to contribute 100% of their wages. But now the difference is they're looking to make more than just the employee, more than just the salary deferral. They'll also want to make the employer contribution. So in that situation, they could have $30,000 of W-2 wages or $40,000 if they're 50 or older, because now they're still going to be able to contribute 100%, all of those wages to the plan, right? Because they're going to be able to do 22,000, like if they have $30,000 of W-2 wages because they're under 50, they'd put in 22,500 as an employee, could be pre-tax or Roth, and then they do the difference as an employer, right? That's the 7,500. That's 25% of those W-2 wages. Now let's assume that they're 50 or older. Now they can do 30,000 as an employee, right? Because they get the $7,500 catch up. And then they do 25% of 40,000. So that's 10,000 as an employer. So in both of these scenarios, they're putting 100% of those wages into the solo 401k. All right, so now let's go to scenario number 3. So this person is not so concerned about keeping their W-2 wages low. They just really want to maximize that those pre-tax contributions, right? To maximize that income tax reduction effect or benefit. So it's the same type of situation, right? It's a one participant plan. The business taxed as an S-Corp or a C. They don't make contributions to another plan like a day job plan. Again, the goal here is maximizing those pre-tax contributions. They'd be looking to use both employee or employer. How much self-employment income do they need? Well, if their business is taxed as an S or a C, it's based on the W-2 wages. They would need at least $174,000 of W-2 wages. So let's break it down. So in that situation, they'd be able to contribute 100% dollar for dollar up to $22,500 as an employee. Again, pre-tax. If they're under 50, if they're 50 or older, they could go up to $30,000. Again, 100% dollar for dollar because they get that $7,500 catch up. And then on top of that, they can make an employer pre-tax contribution equal to 25% of their W-2 wages. So that would be $43,500. So at the end of the day, they'd have $66,000 if they're under 50 or $73,500 if they're 50 or older in their pre-tax employee sub account. And that would all be reducing their taxable income by that same amount. All right, scenario number 4, totally different direction. Now this individual wants to maximize the Roth contributions. So we're still working with the self-employed business taxed as an S or a C. It's a one participant plan, this individual does not make contributions to the day job plan. And their goal is to maximize Roth and or voluntary after tax. And again, we're going to assume here that the individual is not making employer contributions as Roth contributions because doing so offers no substantive advantage over our plan, which already allows for the Mega Backdoor Roth contributions, the voluntary after-tax contributions. So in this situation, this individual would need $66,000 of W-2 wages or $73,500 of W-2 wages if they're 50 or older. So let's break it down and see how it would flow. So in this situation, they would be making, I should say Roth instead of pre-tax, but they would be making a Roth contribution of 100% of their W-2 wages, dollar for dollar, up to $22,500 if they're under 50, or $30,000 if they're 50 or older. And then they could do the difference as a voluntary after-tax contribution. Because again, that limit is dollar for dollar, 100% of those W-2 wages. So that after-tax contribution would go into a separate after-tax account and then could be moved over to the Roth solo 401k account. So at the end of the day, they're going to have $66,000 in their Roth solo 401k if they're under 50, or $73,500 if they're 50 or older, just based on those, $66,000 or $73,500 of W-2 wages. So hopefully that helps and makes sense. That takes us to the end of the slides that we wanted to share. We encourage you to reach out on the forums. You can contact us at our contact information here, for example, business@mysolo401k.net. Please like and subscribe as we'll be continuing to go through these or offering these video webinars here on a weekly basis is the idea going forward. So the future, we'll be talking about different types of self-employed businesses, sole proprietor, for example, partnership, etc. So now let's go to the questions that are being chatted up. Thank you so much for bringing the good questions. On the employer contribution for 2023, does it have to wait until 2024 to make profit sharing contribution? Or can the employer make the 25% in 2023 along with the paycheck? So yeah, there's no good question. Thank you so much for bringing it. You do not have to wait until next year to make contributions. So if the plan is set up here in 2023, if you have the self-employment income to justify the contribution, the individual can go ahead and make those 2023 contributions now in 2023. Even though you have the ability to wait until the business tax return deadline next year to make those contributions, you don't have to wait until the deadline to make those contributions. So hopefully that helps. Thank you so much for bringing the good question. So let us know if there's any more questions. Thank you so much for the good participation. Please, again, like and subscribe. Please continue to participate. We have the daily webinars on our community, mysolo401k.net/my community, for example. Is there any benefit in doing Roth employer contributions if all your 401k contributions will be from your own S-Corp? With only one employer contributing, your total limit stays at $66,000. Well, yes, certainly, regardless of whether contributions are made as Roth employer or pre-tax employer or employee or after tax or all of the above, you're going to be limited to that overall limit, right? So the fact that under the rules, the employer contributions could be made as Roth contributions doesn't allow someone to go over that $66,000 limit. And there's no benefit because your business happens to be taxed as an S-Corp. So in other words, we would still stand by what we stated up above, that the change that allows for employer contributions to be made as Roth contributions still does not offer a substantive advantage over just simply making the contributions as after-tax contributions, like our plan has always previously allowed. So hopefully that makes sense. Let me know if that doesn't get at your question. At what age can one start withdrawing income from the solo 401k? Well, so it does depend on the rules, which depends on the facts and circumstances, right? There's different exceptions, etc. But the general rule is that you cannot take money out of the solo 401k unless you're at least 59 and a half years of age. So we have a good page on our website that gives a good deep dive overview of those rules. So let me chat over a link to that page. Thank you so much for bringing the good questions and participating. Here's the page regarding making solo 401k distributions. All right, everyone. Thank you so much. Have a great weekend. And until next time, take care.